Hi, I'm Midas of Midas Investing, and today we're going to be taking a look at F&G Annuities in Life, which trades under the ticker FG. If you've watched my content before, you probably would know that I already do have some holdings in FG, just full disclosure, as it was a spinoff from one of my main holdings, F&F, Fidelity National Financial. Fidelity National Financial decided to disperse 15% of the shares of FG while maintaining 85% ownership. It's important that we have an understanding of this control over the company from this other parent company, as it does essentially operate as the elephant in the room. Please like the video. It's the best way you can help us with the YouTube algorithm. And if you're new to the channel, please subscribe. And also consider joining our free Discord channel. The link is in the description below. So F&G is a company that sells annuities and other life insurance products. If you're not already aware, an annuity is a form of a retirement insurance product where essentially you can pay either a lump sum or regular premiums to an insurance company, and they will invest in it on your behalf and then promise to pay you a certain income stream at some point in the future for your retirement. Now, as with any insurance company, the primary way in which F&G makes money is essentially by taking these deposits from their customers and by essentially having a delay between when they take the deposits and when they have to start paying out the premiums. This gives them a insurance float upon which they can earn their own yield. Overall, this works very well for insurance companies. They can essentially build these relationships with customers that last very, very long periods of time, to which they can offer them different products throughout their life cycle. What with all the concerns in the news lately with financial institutions that have poorly matched their asset duration to the liability duration, it's very important that we take a look at that, considering this is a company that does indeed take deposits, even if they're not expecting to have to pay out against those deposits in the near future. For example, this particular page right here in their presentation shows that the weighted average time remaining in the surrender charge period they have is 6 years. Now, what this means is they actually have a fee charge that they can place against their customers if customers take deposits out sooner than the actual planned time frame of the overall payments for the annuity liabilities. They have the ability to withdraw from the contract, but it's going to cost them a certain surrender charge, which at a weighted average is about 7% across their portfolio. And it's going to be about 6 years on average against the current level of deposits before this surrender charge would disappear. So effectively, customers would have to wait 6 years to take their money out, or pay about a 7% charge across the accounts to do this, giving them essentially a buffer against perhaps unrecognized gains or losses, like some of the situations that's been going on in the market currently. Now, it's good to see that the liabilities themselves have about a 7-year duration, unless the savers themselves want to surrender a significant surrender charge to the company. But what about the assets themselves? Are they well balanced within that? Are they going to receive the proceeds of their assets sooner than the liabilities? Well, it turns out they're pretty well structured for that. They actually have a section in their 10K that shows the overall duration structure of their investment portfolio. Total portfolio, excluding cash equivalents, derivatives, policy loans, and common stocks, all of which are pretty reasonable, have reasonable reasons why you would exclude them from this calculation. Really just adds more conservatism to this calculation. It shows that you can see 53% of their assets are set to mature within 0 to 4 years, 21% more within 5 to 9 years, and overall the weighted expectation ends up being about 5 to 6 years for the duration of the portfolio. So yes, while if you do come in here and take a look at the actual components of their investment portfolio, which they do have a pretty significant $40 to $41 billion portfolio of investments, mostly fixed maturity available for sale of securities, but a significant portion of non-available for sale of securities. And with the available for sale securities, that means they have to be listed at fair value, including unrecognized gains or losses. And they are in fact sitting on top of a pretty significant section of unrecognized losses, that being about $4.5 billion currently. But again, that doesn't matter if the assets are going to mature within a 5-year to 6-year period, and the liabilities themselves are not going to mature for 7 years. And then if some of the people decide to take their funds back, then they get the surrender charges, which can cover the difference. So they actually are well situated for dealing with this environment. Now, as I've said, their primary business is the selling of fixed index annuities, which an annuity, as I said, is a form of income stream that is placed over a different period of time. Fixed index means that they have the value of the overall payments tied to a specific index, often equity indices or commodity indices or other things like that. And then these things grow over at a certain specific rate over time, which is part of the reason that I think there's a huge opportunity for these products, because these types of products have actually the opportunity to grow their earnings relative to rising interest rates. They do talk here about where the larger opportunity for the purchase of these fixed index annuities comes from is from the large amounts of savings and deposits that the American consumer currently has within the middle markets, people who are not quite in the lower or even the lower end of the middle class, not really in the upper class, but really in kind of like the middle range of people who don't really have so much assets that they can live off of large portions of equity portfolios or their own businesses, and other people that just don't have enough money. There's this large section in the middle with some money and not really knowing exactly what to do. So being able to build these retirement income streams is a huge opportunity, both for the consumer and for the people providing those income streams. However, there is other types of income streams that this company is looking to diversify into, particularly pension risk transfers and funding agreements, which is essentially an agreement between F&G and other large corporate entities that have huge amounts of pension liabilities that they themselves do not really want to manage the risks for. The F&G will then take on as their own form of liabilities, other forms of contracts that they're going to have to pay out income streams against, using their expertise within the industry to identify specific pension transfers that they can onboard the risk without it being a huge problem, as well as other types of funding agreements that have similar profiles. This provides another large market opportunity for this company, which you'll see with the valuation and the model that I built for them. I've essentially ignored this opportunity entirely. So it's important to mention that this is actually a huge icing on the cake that exists, and the company is looking to expand into it. So you might say, okay, that's really, really interesting, but what's the real opportunity here? Just because there's a large amount of savings, that's what the opportunity is. That's why we're interested in this space. Well, actually, the thing about this is part of the reason I'm interested in this industry and this company in particular is because we're sitting right on the cusp of a huge secular change within the demographics of the country. As they talk about within their 10K right here, we're in the midst of an age wave with 10,000 baby boomers retiring each day through 2029. This is the 2022 report. If you're not aware, 2023 is actually the weighted average retirement year of the baby boomer population, which baby boomer population is the largest generational wave that the United States has ever had. This is basically creating a large amount of people that have a significant amount of assets relative to other generations, and they don't necessarily know what to do with those assets to provide for their incomes in retirement, particularly that middle section that we were talking about, people who don't necessarily have huge equity portfolios or huge owned business assets or things like that, but don't have nothing. They do have something and they need to put it somewhere. Further down in the 10K, they talk about the U.S. Census Bureau's projections that the U.S. population over the age of 65 will grow from its current level at about 18% in 2022 up to around 21% in 2035, which may not sound like a very large change going from 18% to 21%, but again, this is percentage of the overall population while the overall population is still continuing to grow. They also talk about the fixed index annuity industry as a whole here, saying that the industry grew from 12 billion in sales in 2002 to 66 billion in 2021. They have similar information to some of the previous reports, which I'm going to rely on in my projections as part of a projection with where the overall market is going to go. And switching over to the Federal Reserve website, I did want to actually show this population over the age of 65 being up at that level that they were talking about in that report. I did want to check up on that, make sure that wasn't just some number that they threw out in the report. You can see the dramatic growth in the overall senior population of the United States. I actually went and tracked down some of these projections from the CBO website, and they actually have this information basically equivalent to projection numbers right here. And you can see that by 2032, which is going to be the projection year that we're aiming for, it seems to be about a 20% expectation for the senior population. I did also find this article on PR Newswire giving an overall estimate for the entire annuity market, not just the fixed index annuity segment of the market, showing it in 2021 being valued at around $232 billion in overall sales, with the expectation of it going towards nearly $300 billion by 2026. This is just more industry information projections that I'm going to use as part of building up my overall model. And then also on S&P Global, I found this very interesting article talking about the potential for the annuity market to grow in a rising rate environment, which backs up some of the ideas I was talking about. But it also had this table in here showing the overall fragmentation of the market, which I thought was just really interesting information. You can see the total US life industry right here in 2021 was estimated at around 817 billion in total sales. But that, again, that's the total life insurance industry. And we were just seeing that the fixed or the annuities industry as a subsection of that was more like 200 and some billion, and then the fixed index annuities subsection of that gets down to more like 66 billion. So you can see just how small of a segment of the overall life insurance industry that we're really trying to focus on. And we're saying that basically the entire life insurance industry is likely to grow, with the fixed index annuities segment growing probably within that as well. But another thing that's interesting about this is it's talking about some of the fastest growing members within here. And you can see that even these top 10 fast growing members really only makes up about like 30 to 35, maybe 40 billion of the overall sales within that 817. It doesn't list it by the largest or anything like that, but either way, I think it shows the huge fragmentation within this industry, which creates another opportunity for any sort of growing company within it, which is to acquire other companies within. As I was saying earlier, that is part of what makes an insurance company have the ability to grow, is that they build these relationships with other clients, and then they can expand and offer them other services. One way to offer a customer another service is to acquire another company that builds that service already, and then you're just giving them the relationship to work with. But what about those numbers in terms of savings of the dollar opportunity that they're talking about? Is that as realistic or not? Well, here's this interesting graphic from Visual Capitalist that I found right here, that I think is really important to kind of understand about the demographics of the United States in terms in relationship to the distribution of wealth, which is to say that older people tend to be wealthier. And it's pretty obvious when you think about it, because that means they've had more time to do the saving. This is obviously not always true, but that's just typically how it is. So if the boomers are basically going to be in this range between 55 and 74, these two different groupings here, they're either close to retirement or going into retirement as it currently stands. Although it's worth noting that this information does come from 2019, but the data does itself actually come from the Federal Reserve website. But you can see that the average net worth for those two groupings was around 1.2 million versus 1.2 million in these two separate age groupings. Very, very high, not too different from each other. And then the medians are also relatively high compared to the other groupings, but significantly far from the averages, but also not far from each other. But the median number, I think, is the one that we particularly want to focus on, because basically that means half of the people within that group are below it and half the people are above it. So it gives us kind of a midpoint. So around 200,000 in net worth is what they found in 2019 dollars. It has been a few years, and we've had inflation, so these numbers aren't going to be one to one. But the point is, I just wanted to try to get an idea of understanding what they mean by the middle Americans, because we're talking about middle Americans relative to the seniors. That's the thing that kind of has to be understood here. All right, so coming back over to the Federal Reserve website, I have a few other graphs I kind of want to show right here that goes with that. Now, to kind of be a sample for the market that they're focusing on, what I'm going to use as my kind of proxy for the population that they're focusing on is the overall section of the US population that has the 50th to 90th percentiles of wealth, which means above the half point range, but below the 90th point range. It's a 40% section of the population, which this is over the entire population, not just over seniors, because unfortunately I can't get data disaggregated that well. But I just wanted to get an idea of showing you where the wealth is, and like what types of assets that wealth is distributed into. And this gives us an idea of like what type of money we can build into our overall market expectations. So here I have the shares of net worth. You can see that the bottom 50% have a very small percent, single digits overall, while the 50 to 90th percentile has about 28 to 29% of all the assets, or net worth, not the assets, net worth. And 37% is owned by the 90 to 90th percentiles, and then the top 1% owns a pretty significant slice, around 32%. So you see, like, those are all pretty close ranges. And again, we're talking about the red line right here as our target range. So there they have about 28 to 29% of the overall net worth of the country. But then again, that's 40% of the population. So it's like, if you take that overall net worth and divide it by the 40% of the population, what is the average within that section of the population per person of net worth? And it turns out it ends up being about $740,000 per person within that 40% middle American section, as we're kind of defining it, which we're going to, like I said, take as maybe a proxy for the retiring boomers. So what is this $740,000? Like, what is it actually in? Now, I decided to break it up into a few different groupings to give you an idea of like where these assets are distributed. This first graph that I'm going to show you right here is a section of assets that I think they effectively can't really do anything with. These are not assets that F&G can necessarily get hold of, because either these are assets that are wasting, or they're assets they have that are balanced off by certain other liabilities like mortgages or other debts that still exist within the net worth calculation. Specifically, we have consumer durables, which is like all the physical stuff in your house. You're not going to be able to sell this to give to an annuity company. Miscellaneous, which is a category that includes all sorts of stuff that I'm not really sure what it is, so we're just throwing it in there. Currency and checkable deposits. This is the cash that they have on hand, which you're going to assume that they probably have it on hand because they assume they need it. So we probably can't take that out of their hands either. And then money market fund shares, which are pretty close to cash. We can count that all in there. So all that together is like about 80 to 90 billion worth that is effectively unavailable as a liquid asset to be sold to possibly be funding any sort of liabilities. Other assets that they have on hand that they could maybe actually possibly sell would include maybe investments, things like debt securities, bonds, corporate equities like stocks, time deposits and short-term investments, which is like their savings deposits where they're getting a measly interest rate, but not a good enough interest rate. Perhaps an annuity could offer you a better interest rate. So between, for example, the debt securities and the time deposits, which is the purple and the blue line, overall, that makes up a pretty significant slice. 12 billion for the debt securities, about 71 billion for the time deposits. That's like 80 billion right there that probably could be turned into annuities, and it would be beneficial for both parties. Then there's the stocks, which makes up about 82 billion. Now look, the retirees could manage their own stocks and they could probably get good yields off it, but do they want to? Do they want to be managing a risky equity portfolio in retirement? That's a pretty good option for money that could be turned into annuity premiums as well. And then there's the equity in non-corporate business. This is owned businesses. These are the business owners. Now, a lot of people take pride in being business owners and wouldn't necessarily want to give that up super much. But again, this comes down to what are you doing in retirement? Do you want to manage your business in retirement? I think a decent amount of that might be up for getting those businesses acquired or the assets sold off, and some of that perhaps being turned into annuities. So between all these categories, we have maybe about 100,000, 200,000 almost worth of assets per person that could possibly be turned into annuities. Maybe only half of it gets turned into annuities, and that's $100,000 per person within this middle range of Americans right there. But that's not all of their assets. They also have their real estate. Right here, you can see real estate per person ends up being over 300,000. Now, I would say that a significant portion of the real estate is not necessarily going to be an available portion of this market because people do have to live in their homes. But some of this real estate is going to be second homes and rental homes and things like that, which then comes down to the question of whether or not they want to manage that cash flow themselves, or if they want to maybe liquidate out of it and turn it into an annuity payment as well. So maybe there's a portion of this 300,000 that could be available. And again, this would also be offset by the mortgages, but the illiquid assets and all those other things, part of the reason I was avoiding including those is because I wanted to have those non-available assets balance off the liabilities. So I'm actually willing to include the real estate here as in terms of a total asset. But again, a large portion of it probably people will want to use as the lived-in portion of the home, maybe 75%, maybe 90%. I don't know. There is also then the pension entitlements, which gets back to that other section of the business that I was talking about, the pension risk transfers. The actual investor, the Americans themselves can't really control whether or not those pensions are transferred over to FG, but this is something that the businesses that manage those pensions themselves could choose to do over time. There is over 200,000, 250,000 per person in this middle American category worth of pension entitlements, and that actually makes up outside of the real estate, the lion's share worth of retirement assets for these people. So with all that overview of the state of the American demographics, the state of the American consumer, and the general perspective of the annuity market as it has the potential for growing over the next decade, we come over to here to my model that I put together for this space as a total. We have here the estimate of the total life insurance market we got from that one article, with the estimate of the annuity market size as well as the fixed index annuity market that was given within the 10K. This gets us an estimate that the annuity segment is about a 29% segment of the annuity market within itself. 2.5% is the overall market share that they have within their segment, and that grew from less than 1% before they were taken over by F&F, showing how that when they have the access to these already existing client relationships, because for example, F&F already has a 32% market share of the mortgage refinance title insurance space. So the point is they have these relationships that they can then bridge into other ones, and then you can get a 15x in the market share over a 2-year period. Now, comparing that 2.5% of just the fixed index annuity segment, you can also then say, well, what is their market share of the overall annuity market itself, which in 2022 was less than 1%, and their market share of the overall life insurance space was only 0.2%, showing that if they were to expand outside of just fixed index annuities, there would actually be even more opportunities. But even so, we're primarily building this model just off of the fixed index annuities market space that they themselves say that they're a part of. Now, using the estimates of the percentage of U.S. population that are seniors, as well as the actual calculation of the population that we have, and then compare that against the 40% estimate that we're seeing as our estimate of what are middle Americans within that space, and then we get an estimate essentially of what we think the middle American senior population can be. If we take that and then divide that into the overall segment size, it gives us an estimate of the amount of revenue per senior that could theoretically be within that. And it gives us an estimate of potentially the type of fee that each senior could be charged, assuming all of the seniors within that 40% were actually going to be part of this market. And that gets us this kind of $3,000 to $4,000 range over this 3-year period that we are actually able to get these numbers. The problem, I will say, with this overall model that I'm building is that there's actually very few years to work with for the historical data and just a lot of projections as far as the historical reports, which is part of the reason that I started this with trying to show you all the demographic and savings information that I think really builds a strong thesis for where this is going. It's hard to say what the magnitudes of all this is going. I can just for sure say that this is going somewhere. And so we're really just going to be building this off of very, very conservative estimates. And I'm trying to build the case for you that there's actually lots of excess opportunity that I did not build into this model. So coming over here and taking a look at the projections for 2032, in the research report, we had the estimate for what the annuity market was going to be in 2026. I'm assuming that the fixed index annuity market is basically just going to grow in line with that. And then whatever distance it grew up from 2023 through 2026, all to 2032, I'm assuming it's basically just going to grow approximately the same amount in overall dollar terms. And overall, that gets me to a fixed index annuity estimate of maybe 107 billion in 2032. This is against the 68 billion that it is in 2022. So that's almost a double, not quite a double for the market segment size. Then for my estimate of market share, I'm actually just going to be very conservative here and assume that they can keep the 2.5% that they have in 2022. I'm really just relying on the fact that this industry is growing to show you as at a base level where these overall insurance premiums can go. And their premiums in revenues in 2022 was about 1.7 billion. And if you just multiply the overall market size times the market share, that gets us to overall insurance premium revenues of 2.6, 2.7 billion in 2032. Now, much with our kind of estimate we did here of segment revenues per middle market senior, I did the same thing on the other end of the scale here, showing that with the expected levels of middle market seniors that will be there with the segment size we came up to, that gets us to a growth of revenues of up to possibly 3,700 or so in revenues for each senior relative to the numbers we had in the past. That shows us that I don't think we've exploded the number beyond reason. In fact, it's actually pretty close to the number it was in 2019. So I think overall our market growth expectations are not outside of some sort of reasonable expectation of growth in terms of what type of revenue would be expected per policyholder, per senior involved in such a policy. Then coming down here, we also have projections for the investments and the investment income. In their 10K, they give us information about the total number of policy holders that they have by year, showing that they actually have about 623,000 policyholders as of 2022. And then we also have the fair value of the portfolio as it's listed in the 10K right here. And if you just divide between the two, you get an estimate of the total amount of portfolio assets per policyholder, which we have down here, showing that it grew from about $43,000 in portfolio assets per policyholder up to $65,000 in 2022. Now, again, think about this $65,000 per person number relative to the numbers that we were talking about of total net worth within that middle market area of 740,000. So the idea that maybe out of the 740,000 net worth that they found $65,000 to put away, I think it shows us that maybe this range of overall net worth that we were looking at is probably maybe a reasonable actual market estimate. And then also relative to the other assets we were talking about, maybe not these unavailable assets we were talking about, but some of the more liquid assets or sellable assets that we were talking about right here, you can see that they're actually, it is pretty reasonable to see how that type of money could be gotten from each policy holder. Then coming back up here briefly to the actual premium numbers, with the policy numbers that we have down here for the investments, we also can then work backwards with our own estimates of the policyholders to get an idea of just how much premiums per policyholder we would be demanding in 2032, which our estimate ends up being about 3,400 relative to the 2000s levels that we had in 2021, 2022, showing, I think, also not an entirely unreasonable level of growth over an entire decade, especially given inflation. So for the actual projections of the investment income, first I make a projection of growth for the actual assets per policyholder over the time frame. I'm making my estimate be 2.25% per year, which is really just the market set estimate over the next 10 years of inflation expectations. So really, I'm just saying I expect portfolio assets to grow at approximately the rate of inflation, which gets us to about $82,000 per policyholder in 2032. Then I assumed policyholders were going to grow at basically the same rate as the overall segment grew. And they could grow at a much lower rate of rate, and then the assets themselves grow at a faster rate, or they could grow at a faster rate, and then the assets per person could come down. I'm overall just assuming they're going to grow in tandem with each other, which just kind of keeps things more consistent. And then between those two metrics, that actually works. You can work backwards to get us to a portfolio fair value of around 63 to 64,000 or 63, 64 billion. Then as far as investment yield, I'm going to rely on the 3-year average, the most recent 3-year average, which is more conservative than using a longer term average, which is why I'm relying on that particular number, which gets us 4.1%. And then that gets us to investment revenues of 2.6 billion or so. In terms of gains or losses, I'm just putting 0 in, which actually happens to be the average of the historical range of gains and losses. But as I was saying before, with a fixed income portfolio being held to maturity, we wouldn't really expect gains and losses to actually be an effective contributor to the revenues in the long run anyway. So between these two segments, we can add them together, and that gets us to F&G total revenues in 2032 of $5.3 billion. Now, since this valuation is so heavily dependent on growth within an industry that's very uncertain, I decided I did want to actually make a little bit of some variability within some of the factors used here and build a more bearish projection as well as a more bullish projection. So what with our segment size, I had initially assumed that it just kind of remains at about 30% relative to the overall annuity market, but the overall annuity market is the market that's growing, so it's possible that the FIA segment within it grows or shrinks relative to that. So on a more conservative basis, to be bullish or to be bearish, I'm assuming maybe it shrinks down to 22%, which would be 75% of the current level, but maybe it actually grows by a couple percentage points up to 32, 33% of the overall annuity market. Likewise, the market share estimate that I use, I assume they kept their market share at 2.5%. They could easily get it cut in half, maybe down to 1.2% in a more bearish estimate, but they could also easily grow it by possibly 50% up to 3.7% market share. Hell, it could easily go way past that, especially like I said before, how fragmented the overall life insurance market really is, especially compared to the really large customer relationships that F&F, their parent company, has already built, as I said before, with a 32% market share in mortgage refinance title insurance. Now, it's a different industry, different space. They probably can't get it anywhere close to 32%, but who's to say they can't get it up into the 5 to 10% or something like that? Again, we're talking about market share within just the fixed annuity segment. We're not even talking about the overall market share of the annuity market or the life insurance market, which, as we saw before, was less than 1%. And I'm not making any sort of projections on that. So imagine that they also then maybe expand into some of those other areas. And then again, don't forget about the pension risk transfer agreements, which again was another form of icing on the cake that could exist within this, with the, what was it, 256,000 per middle American that exists there that we're not really talking about. But again, that's stuff that it's hard to project because it involves the decisions of other companies and we can't really provide for that. Now, using those divergences and those variables, that actually changes the overall insurance premiums to, in the bearish scenario, to end up with 792 million as the overall insurance premiums, which is a pretty sad number overall compared to our kind of baseline estimate. And then the bullish estimate gets us up to 4.6 billion. So you can see the drastic change that creates. I also included the way that these numbers changed the estimated premiums per policy, since this was more like a sanity check type estimate thing to make sure that our estimates weren't crazily out of whack. And you can see that they're actually pretty well within the ranges of it. Both of them end up being lower. The insurance premium that we have for our actual revenues end up being lower than the sanity check number, showing that these estimates, I think, are actually still within a reasonable estimate. And then when it comes back to this concept of these premiums per policy, again, this is talking about like what theoretical revenues could the policyholders actually afford to be paying, and it actually still be a viable investment for them. I did actually take an estimate of the net worth of those middle Americans in terms of life insurance assets as well. If you take the overall average amount of life insurance assets and then subtract out the life insurance liabilities, because people tend to have a bit of both of them simultaneously, you find out that currently the amount of overall net worth in terms of life insurance that the average middle American currently has is about $12,000 per person. So I think that shows that these numbers right here in the kind of single digit thousand range shows that in terms of the overall total life insurance policy, the amount that the fixed index annuity slice is trying to demand is all, again, within a reasonable range. This is, again, more like a sanity check figure than anything else. Then I did make some variability on the investment income assumptions as well. I had within the assumptions, I just assumed that the policyholders grow in line with the overall market space, but they could grow faster or slower than that significantly. Maybe it only goes to 626,000 policyholders, which would basically be zero growth in terms of policyholders. And then maybe they actually grow significantly faster than that, getting us closer to 1 million policyholders. There's also changes within the growth of the portfolio. I used inflation, an estimate of inflation as my gauge for the growth of the assets per policy, but they could easily just not grow at all, and they could easily grow twice as fast as that. In fact, it could easily grow much faster than twice as fast as that. I think this is still leaving plenty of room for upside potential as well. But within those changes to those variables, that gets us to investment revenue assumptions of 1.7 billion to 4.1 billion on the bearish side, or on the bullish side. If you add those together, that gets us to a wider range of revenue expectations of maybe 2.4 billion on the bearish estimate, the 8.7, 8.8 billion on the bullish estimate. Again, our more base case being about 5.3 billion for 2032. Coming quickly over to our industry data set to get some of the other information that we're going to need to build up our overall valuation. If you take a look right here, you can see our sales capital ratio for the life insurance industry for the last 5 years has been 68 cents for each dollar of capital invested versus 71 cents for the last 8-year average. Likewise, you can take a look at the adjusted operating margins for the last 5 years have been 10.6% versus 11.4% for the 8-year average. And then you get gross margins for the last 5 years have been 29%. So not the greatest of gross margins, pretty decent operating margins, and then not the greatest of capital costs for the industry as a whole. And you can compare that with the unlevered beta, which is actually relatively low at a 0.79. That's before adjusting for the leverage of a company. But again, we'll see how that plays out for FG specifically. With my cost of capital assumptions in place, you can see all right here with the unlevered beta, the current risk-free rate, and an estimate between their most recent cost of interest as well as versus their book interest. I kind of took somewhat of an average between the two, as well as my projected tax rates and debt to equity ratios over the projected period. I end up with a cost of capital of around 7.5%. If their beta would move towards 1 and other assumptions would move towards a more mature profile, I can see this cost of capital growing over time. So in my overall valuation, that's what we will see. Now, what with the company being a relatively young company, I don't have a lot of historical data to work with, but I did want to take a look at some of their margin information comparative to those industry averages that we were seeing. We saw gross margins over the last 5 years on average of about 29%. And then the last 5 years for them, it's been about 38 to 39%. So you can see very, very strong gross margins relative to their industry. Also, the operating margins are about 15 to 16% for the last 5 years. And that's compared to a 10 to 11% operating margin for the last 5 years. So very, very strong gross margins and operating margins relative to their industry as a whole. Also, with the sales capital information, we even have even less information to work with, only 4 years, because I can't really count 2020 since that's where they had the purchase by F&F, and so there's a little bit of funkiness going on within their capital structure in that particular year. But the average sales capital ratio that they've had for these 4 years that we do have is about 0.95, so 95 cents of revenues for each dollar of capital invested in the business, showing that they're not only relatively strong compared to their industry in terms of margins, but also in terms of capital assumptions. So pulling all of this together, here we are. This is my revenue projections across different quartiles for the company. You can see that in the interquartile range for our 2032 revenues, we have the upside of 8.6 billion on the bullish case estimate, with about 2.5 billion on the bearish case estimate. So a pretty wide range of possible revenue outcomes for that 50% of total outcomes. The expected revenue that we're using ends up at about 5.3 billion over the time frame. And you can see the cumulative growth graphs as it is right here. Our bullish case over 250% of growth. Our bearish case, basically they're not growing at all, with the base case somewhere in the middle there, incremental numbers here on the right. Likewise, with margins and our operating income assumptions, you can see the interquartile range of operating income in 2032 is between 622 million and 725 million. So a little bit of a more narrow range comparative to the revenue assumptions, which I think just has to do with the disbursement of the overall margin assumptions. You can see we have pretty wide margin assumptions in the short run, which moves towards a little bit of a higher profitability in the kind of middle period, as we expect the market to be really taking off during that time frame, and then the margins will come down towards their more terminal level. The actual average of margins over the entire time frame ending up still around 13%, which kind of puts them between the midpoint of where their historical margins have been and where the industry margins have been. So we're seeing them kind of moving towards the middle there overall. You can see the distribution of operating incomes right here, with the vast majority of the outcomes really right here at around like 750 million or so. Capital assumptions with the sales capital ratio, as we saw that their sales capital ratio for the few years we had being a relatively strong, over 1 or close to 1 for most of those years, and it was actually growing if we're discount the 2020 year where we had the funkiness going on. However, the industry has the sales capital ratio as being less than 1, and so especially with the relatively good margins they have, I do allow them to have pretty good capital in the short run, and then move towards kind of a longer run industry average of the capital assumptions. You can see the movement of the investment, the returns on invested capital assumptions as it has right here, with the capital investment quartiles over time frame right here as well. The free cash flow distribution, you can see a pretty significant kind of modal output in this kind of like 300 million range, but with significant potentialities of it actually being more in the 200 million range in terms of free cash flow, and also some outcome potentialities even a bit lower than that. But overall, you can see kind of like the average in this kind of space right here. And then all these outcomes build into these quartiles of overall values, with the first quartile of the lowest value being around maybe $16, $17 per share, which makes them about fair value where they're currently at, with the upper quartile of upside of maybe around $31 per share, which would be 85% of upside, with the expected value, the average outcome being about $24 per share, maybe about 45% of upside. You can see the fair value distribution of the price right here. Yeah, the vast majority of these outcomes kind of in this $15 to $30 range, very, very solidly in the mid 20s perhaps, with the expected returns right here. Very, very solid teen range, or teen percentage range of anywhere from 10% to possibly around 19%, the vast majority of outcomes. Please like the video. It's the best way you can help us with the YouTube algorithm. And if you're new to the channel, please subscribe. And also consider joining our free Discord channel. The link is in the description below. And here you can see a more simple presentation of the expected DCF outcome right here. Again, the fair value about $24.31 per share, upside 45%, putting them currently at about the 25th percentile of the value distribution, which means that there's about 3 times more outcomes to the upside than there is to the downside. So this has been my valuation for F&G Annuities in Life. As you can see, I think it's a very great opportunity that exists in front of us right here, both in terms of the growing industry as a whole, as well as this specific opportunity. As I said at the start of the stream, considering F&F, Fidelity National Financial, still maintains 85% ownership of the common stock of F&G, it's probably important to have an idea of how that valuation stands as well. So you might want to check out my value for that company after this one. Catch you all in the next valuation. Bye.